Welcome to Iraqi Dinar News, where you receive real and authentic updates about the Iraqi Dinar. If you want to stay informed with moment-by-moment developments, make sure to subscribe to the channel and like the video. Today we're analyzing a statement that has been circulating widely in dinar discussions. The core of the argument is that historically the Iraqi dinar was valued higher than the Kuwaiti dinar, that Kuwait's currency currently trades around $3.26 per dinar, and that if sanctions were removed and past policy decisions were reversed, Iraq's currency could theoretically return to around $3.22, potentially even higher after adjusting for inflation over the past 2 decades. This is a powerful narrative. It references history, it references sanctions, and it references a comparison with Kuwait. But as responsible financial analysts, we need to break this down carefully, look at the economic mechanics behind currency valuation, and separate historical fact from present-day monetary reality. Let's begin with the historical component. Before the 1990 invasion of Kuwait and the sanctions era that followed, the Iraqi dinar was indeed officially valued at over $3 per dinar. That was during a very different monetary regime, under a centralized system with tight capital controls and a managed exchange rate structure. However, it is essential to understand that official exchange rates during that time did not necessarily reflect a freely traded, market-determined value. Iraq operated under a fixed exchange rate regime with significant state control, limited convertibility, and strict capital movement restrictions. When Iraq invaded Kuwait in 1990, the geopolitical consequences were severe. The country faced comprehensive sanctions imposed by the United Nations and enforced through mechanisms that included oversight by agencies such as the U.S. Treasury's Office of Foreign Assets Control, commonly known as OFAC. These sanctions severely restricted Iraq's access to the international financial system, oil revenue flows, foreign reserves, and international trade channels. As a result, Iraq's economy contracted dramatically. Hyperinflation followed in the 1990s, and the Iraqi dinar collapsed in real purchasing power. After 2003, the monetary system was restructured, and the Central Bank of Iraq implemented a new exchange rate framework, eventually stabilizing the dinar in the range of approximately 170 to 320 dinars per US dollar, depending on policy adjustments over time. Now let's address the comparison with Kuwait. Kuwait's currency, the Kuwaiti dinar, is currently one of the highest valued currencies in nominal terms globally. Kuwait maintains a managed float regime, backed by substantial sovereign wealth assets, consistent oil revenues, a relatively small population, and strong fiscal buffers. Kuwait's macroeconomic structure is very different from Iraq's. Its sovereign wealth fund is among the largest in the world relative to population size, and it has maintained long-standing financial integration with global markets. It is true that before 1990, Iraq's official exchange rate was higher than Kuwait's. But that historical comparison must be contextualized. Exchange rate value alone does not determine economic strength. What matters more are fundamentals such as foreign reserves, money supply, fiscal discipline, inflation rate, GDP per capita, productivity levels, and political stability. The claim that simply undoing what was done or removing sanctions would automatically restore the Iraqi dinar to over $3 assumes that exchange rate levels are politically reversible switches. In reality, currency valuation is deeply connected to macroeconomic fundamentals and market confidence. Let's talk about sanctions. Iraq today is not under the same comprehensive UN sanctions regime that existed in the 1990s. However, it still operates within a complex global compliance framework, especially regarding US dollar transactions. The US Federal Reserve Bank of New York plays a central role in clearing dollar payments for Iraq's oil revenues. Compliance mechanisms, including anti-money laundering and counter terror financing standards directly influence how smoothly Iraq can access its foreign currency reserves. If all compliance concerns disappeared overnight and Iraq had completely unrestricted access to global markets, would that alone justify a $3 exchange rate? Not necessarily. The exchange rate must be supported by foreign reserves, trade balance, and money supply dynamics. Currently, Iraq's monetary base is significantly larger than it was in the 1980s. Over the last 2 decades, the Iraqi government has expanded spending substantially, particularly on public sector salaries and subsidies. The money supply has grown in parallel with oil revenues. For a currency to revalue upward dramatically, either the money supply must contract sharply, foreign reserves must expand massively, or both must occur simultaneously. Another critical factor is the exchange rate regime itself. Iraq currently operates a managed exchange rate system. The Central Bank of Iraq intervenes in the currency market to maintain relative stability. A move from approximately 300 dinars per dollar to 1 dinar per $3 would represent not just an adjustment, but a complete restructuring of the monetary system. Such a move would require redenomination, monetary reform, or a drastic contraction of circulating dinars. Without reducing the outstanding money supply, a sharp upward revaluation would create severe imbalances. It could disrupt exports, distort government finances, and potentially trigger speculative capital flows. Now let's discuss inflation adjustment. The argument suggests that if Iraq's pre-1990 exchange rate was around $3.22 and we apply inflation over 22 years, the value should now be closer to $4. This line of reasoning misunderstands how exchange rates function. Inflation in one country does not automatically raise its currency value in nominal terms. In fact, higher domestic inflation typically weakens a currency over time unless matched by productivity growth and strong monetary policy. Exchange rates reflect relative inflation between countries, not isolated domestic inflation. If Iraq experienced higher inflation than the United States over a given period, its currency would, all else equal, depreciate relative to the dollar, not appreciate. For IQD followers, the key takeaway is this: historical exchange rate levels are not automatic targets for the future. Monetary systems evolve, economic structures change, population size grows, fiscal obligations expand. The Iraqi economy of the 1980s is fundamentally different from the Iraqi economy of today. In the short term, what matters most for the Iraqi dinar is continued currency stability, compliance with international financial standards, steady oil exports, and improvements in non-oil sector productivity. The Central Bank of Iraq has consistently emphasized exchange rate stability as a policy goal. Stability supports trade, controls inflation, and maintains public confidence. If Iraq continues strengthening its banking sector, digitizing financial systems, diversifying its economy, and maintaining strong foreign reserves, we could see gradual improvements in economic fundamentals. But gradual structural reform is very different from a sudden multi-dollar revaluation. In the medium term, currency appreciation typically requires sustained productivity gains, foreign direct investment inflows, lower corruption, diversified exports, and a credible, independent central bank. Iraq has made progress in some areas, but challenges remain. Political stability, fiscal discipline, and infrastructure development are ongoing priorities. Long-term, the Iraqi dinar's strength will depend on Iraq's ability to transform from a predominantly oil-dependent economy into a diversified regional economic hub. If Iraq succeeds in expanding manufacturing, agriculture, logistics, and services while maintaining macroeconomic discipline, its currency could strengthen over time. But that strengthening would likely be incremental and supported by fundamentals, not by historical comparisons alone. It is also important to understand that nominal exchange rate value does not necessarily reflect purchasing power or wealth. A country can redenominate its currency and move the decimal point without changing real economic value. For example, many countries have removed zeros from their currencies to simplify accounting without creating new wealth. True currency strength reflects economic productivity and global competitiveness. For those following the IQD closely, focus on measurable indicators, foreign reserve levels, inflation rates, fiscal deficit or surplus trends, oil production capacity, compliance with global banking standards, and structural reform progress. These are the data points that matter. It is perfectly reasonable to analyze Iraq's historical exchange rate and compare it with regional peers like Kuwait. However, it is not analytically sound to assume that parity or superiority in nominal terms will automatically return simply because it existed in the past. The global financial system today is far more integrated, transparent, and compliance-driven than it was in the 1980s. Exchange rates are influenced by capital flows, trade balances, geopolitical risk assessments, and institutional credibility. Iraq's path forward lies in strengthening those pillars. In summary, while Iraq historically maintained a higher official exchange rate than Kuwait before 1990, today's monetary reality is governed by different economic fundamentals. Removing compliance restrictions or improving geopolitical conditions could support economic growth and currency stability, but they do not mechanically reset the exchange rate to historical highs. Short term, expect continued focus on stability rather than dramatic shifts. Medium term, watch for structural reforms and fiscal management. Long term, the dinar's trajectory will reflect Iraq's economic diversification, governance improvements, and integration into global financial markets. As always, responsible analysis requires patience and discipline. Currency markets move based on fundamentals, not nostalgia. If you value factual, balanced, and responsible Iraqi dinar coverage, make sure to subscribe to the channel and stay informed with credible updates. And remember, this content is provided for informational purposes only and is not financial advice.